Right, good afternoon everybody. In the course of our video lectures that we've been covering so far, I've looked at various aspects of ratio and analysis and how you need to answer it. Today I'm going to look at a task with you so you can see how to answer it. Now, any tasks that I refer to in this series will always come out of our New Era books, either the textbooks or in this case in the study guide. The benefit of the study guides is that these are typical exam questions and they will go a long way to helping you to prepare for that examination. These books consist of questions. There are memos at the back so that you can mark your own work. If you look here, you'll see that everything has got text so you can mark with all the explanations. There are answer books for you to get, which is exactly the same as what you will have in the final examination. And also, just to draw your attention to the fact that this book is also available in Afrikaans. So, as part of the revision, I'm going to look at question 25 out of that study guide. And you will notice that there are a few questions here. I'm going to break them up and I'm going to do them separately on different video clips so that you can go through the ones that you need help with. If we just quickly have a look at the beginning, it will tell you that this is you've been provided with financial indicators or figures, so you're not calculating them in this case, but you'll be needing those to comment. This is a shoe shop and we've provided with 2 years figures, and they use a markup of 75% on cost. You will notice that the figures are given to you in 20.7 and 20.8. And the first of the questions we're going to look at asks us, should the directors be satisfied with the liquidity of the business and the control of stock? So take note, there are two aspects that you have been asked to comment on. And so you need to look at liquidity and stock. Now there is a whole video clip on liquidity. Remember, liquidity is looking at your short-term current assets and to ascertain whether you've got enough there to pay your short-term debts. So when we're looking at liquidity, we're looking at current assets and current liabilities. Now, in a task like this, you would need to identify which of these financial indicators that are given here relate to liquidity. So, if we have a look here, there you are. First of all, there's our current ratio, our asset test ratio, the rate of stock turnover, how many times a year the stock is turning over, the stock holding period, which is looking at that in how many days. The rate of stock turnover and the stock holding period are actually related to each other. We're given an extra one about stock, the trading stock deficit as a percentage of our cost of sales. We've got the credit terms granted by our creditors and our debtors' average collection period. So in other words, at this stage, those are the ratios that we need to look at. So the first point is it's absolutely essential that you know which ratios or which indicators to look at, because if you don't know that, you wouldn't be able to answer this question. Now if you look on the web, under the actual resources, but under the actual questions, you will find that I have included question 25 in there, this same question, together with the memo. So at this stage, you can print that off the web and use that to help you. So I'm not going to look at the memo now. You can get that yourself off the web, but I'm just going to guide you on how you need to answer this. This is worth 10 marks. So basically, 10 marks, you have to have 5 points in your discussion, because basically a point in accountancy will carry 2 marks. Now that would need, first of all, to identify the ratio or the financial indicator you're looking at. Secondly, you need to compare. You've got to look at the trend. That's why you've been given last year's and this year's. And then if there's any norms or any comments from that, to make up the full answer. Now, if we look here, our current ratio was 3:1 last year, and it's now 3.8. So the first thing I need to indicate is that has actually increased. Whereas my asset test ratio has remained exactly the same. The difference between this is your stock. In your current ratio, it includes stock, whereas your asset test didn't include stock. Now, you remember that I told you in the videos that we do not have norms. We can look at them as a guideline, but they are not a norm that we adhere to, and they are not used in business practice anymore. So what we can say in our answer is that the current ratio has increased. Now, why is that? And if you go down, and your second point now, so you've looked at, in fact, at the third point, you've looked at the current ratio, you've looked at the asset test ratio. We now need to look at our stock. Now, our stock is actually made up of three things here. First of all, it tells me that last year I was selling my stock 4.1 times a year. This year, it's only 3. The higher this is, the better, because that means you're buying and selling your stock quicker. And remember, the working capital cycle is to actually turn your stock back into cash as quickly as you possibly can. Now, 3 times a year, if you divide 12 by 3, you'll get 4 months. And if you look at the stock holding period this year, 120 days, that is also 4 months. Whereas last year, you were only holding 90 days of stock. So here's a very big problem, borne out, first of all, by the turnover rate, and secondly, by the number of days. So this business is definitely holding too much stock, and the stock has been held for a longer period. Now, remember, in the question, they asked us to specifically look at the control of stock. As a result of holding the stock for so much longer, you can also notice that there's a higher deficit, a higher shortage of stock. So definitely from the point of view of a stock, this is the thing we need to flag. This is our problem. And it's the reason why your current ratio has gone up. And the warning from that was to say, look at your stock. However, if we're looking at liquidity, we also need to look at the creditors, the people that we owe money to, and they're giving us 60 days. Now, that would be good in a business sense, because that means they're giving you 2 months before you have to pay for the goods, giving you a chance to sell the stock. The problem is, unfortunately, we are not selling our stock in the 60 days. So again, the stock is what is causing the problem. And then lastly, so if we remember, that was the fourth point. And lastly, if we look at our debtors, the debtors are the people that owe us money. Last year they were paying me in 35 days. This year they're paying me in 28 days. And that is good. That is a very positive move, because your debtors are paying you quicker and you are recovering the money quicker. So to sum up, and as I said, if you look at the answer sheet, you'll see all of this written out in the memo. 10 points, 10 marks should I say, so we have got 5 points there. In those 5 points, we've stated the actual financial indicator. We've stated whether it's increased or decreased, and in that you need to quote your figures. I know it sounds silly to many of you because the figures are in front of you, but we need to know that you can interpret those figures properly. So you need to say that the current ratio has increased from 3:1 to 3.8:1. You need to say, for example, that the stock holding period has increased. They are holding stock for a long period of time. And so from a liquidity point of view, we need to look at our stock in order to improve our liquidity situation.